Marc Lipschultz is the co-founder and co-president of Blue Owl, and he's been in the thick of it for a few decades. And he sees a paradigm shift where private markets, as opposed to public markets, are now the stabilizing force within financial services. A stabilizing force, Marc.
Well, thanks for having me here today. It's great to be back with so many friends and back with you all. Yes, the private markets have evolved. I've been in the now called alternatives investment business for nearly 3 decades. And if we kind of wind the clock back, the LBOs of the time, the sort of handful of shops, KKR where I was, Forsman Little, were very opportunistic, episodic, and the public markets were the primary source of capital. Fast forward to today. And still, the public markets do and always will play a critical role, but private markets have now become a major part of the capital landscape and a stabilizing force. The public markets, and we've seen this several times now over the last few years, open and close, they're all on, all off. The private markets have now become the enduring kind of lower volatility part of this market that stays and continues to provide capital through thick and thin.
There are still some concerns out there, though, about valuations in the private space. Obviously not the same transparency there in the public space, so there's a bit of a guessing game going on right now as to the health of what's underlying a lot of these investments.
So the beauty of the private marketplace is, look, first of all, done right, valuation should always be crystal clear and perfectly accurate. We at Blue Owl have an outside party provide us our valuations. We think it is important. Information counts, transparency counts. But with all that said, let's remember the most important feature, the reason the private market system is working, again, as a stabilizing complement to the capital market system, is because it's got the duration. We're talking about long-term capital to meet long-term needs. And we're sitting here at a moment where we watched a study in the opposite, right? When I have capital that goes away in a minute, that's a real challenge when I'm trying to meet long-term corporate or long-term developmental needs.
But here's the thing that is still volatile, even if you're in the private markets, is this idea that you have to refinance now at higher rates. You're lenders to a lot of private equity-backed companies. What kind of pressure is there to stave off that pain?
So we provide senior secured floating rate loans. So to your point, we're collecting much higher interest rates today on our loans than we were a year ago. Now that's the point. Our model is built to provide that to our investors. We're one of those asset classes where over the last year, we've called our investors numerous times and said, we just want to let you know the returns are going to be higher than we thought. That is not a call they typically get, but it reflects the dynamic you're describing. We are in a rising rate, certainly have been in a rising rate environment.
But your borrowers are then paying more. For your investors, that might be a nice thing to see, that extra coupon. But A, how long does that last for? And B, can your borrowers keep coming back at that rate?
Well, thankfully, what we're seeing is a very healthy ecosystem in total. When we look across our portfolio, companies continue to actually grow. Revenue on average and EBITDA on average continues to grow. So that's actually a really healthy overall sign, not at the same pace it was before. And at the same time, what we are seeing is companies that are well managed, great sponsors, world-class enterprises, they have the durability when they have long-term capital structures. So listen, you have a long-term owner in private equity, and you have a long-term lender in private credit. Indeed, it's going to reallocate a bit of who gets those benefits. We are certainly collecting more from those companies, and there are some perhaps challenges to some of the equity holders. But in the scheme of the overall stability of the system, we all have an eye on, let's make sure this company thrives over the long term.
But with the focus right now on the real estate, on the commercial real estate market, and I guess, if you will, to take your phrase, the long-term structure of those businesses at a time when most people think that we're going through a real structural change in how we go to work and just the utilization of office spaces, warehouse spaces, et cetera.
Yeah, so we're definitely seeing, and for a while it has seemed likely that the origin of some continued challenges would be in this commercial real estate sector. It now seems apparent that that is true. Right, depending on the period of time, whether it's $1 trillion over the next year or 18 months or a couple and $2.5 trillion of mortgages that have to be refinanced, that is a daunting challenge. And so I think that is an area we should all be very mindful of. Look, we're not in the real estate lending business. In fact, our business in real estate is built exactly for today's environment. We provide one kind of solution, triple net lease real estate solutions. We take property from investment grade strong companies and we lease it back to them so they can free up capital to build their business.
But what if those property values fall?
Well, those property values fall. We have a long-term lease with Amazon, with Walgreens, so really they're our counterparty. 15, 20 years later, when those come off lease, well, that's a good long-term question, but that's a very long-term question. Again, the key in our building strategies, and I think in today's uncertain environment, is you want that duration, predictability, and stability.
You're talking about things that are already in the portfolio. What about new business? What's the scrutiny that you apply to that same type of opportunity for something that's not in the portfolio, starting from square one?
Yeah, look, it's an appealing time to be a private market capital provider because we get to have all of those attributes, the deep due diligence, provide a structured solution, a low loan to value if it's a loan, or a really well-structured lease, or a GP stake that we take in a great manager. And we get to do it with the benefit of today's market overlay. So of course everyone's going to be more cautious in their outlook. So it's wonderful to be able to provide that product, that capital, into a market where we all have the increased sobriety, let's say, of today, along with the fact that absent other markets being alternatives, we can get better terms, frankly.
Speaking of terms, you're talking about higher interest rates. I think a lot of the reason we hear this higher for longer chorus at Milken in particular is because there are a lot of portfolio companies here that are experiencing inflation that are still quite hot. Do you believe in this higher for longer narrative, and what does the market have wrong about the current state of play?
Well, look, I wouldn't for a minute think I can outguess the Fed, but I would say the higher for longer, or maybe the way I'll phrase it, the persistence of inflation. The policymakers are obviously trying to walk a very fine line between managing that inflation and managing the economic fallout of an alternative. What I think I can say, looking at several hundred companies that we lend to, is inflation is persistent. And we all know this historically and today. Once it starts, it takes a long time to stop it. So I do think in that regard, the higher for longer force to the degree of inflation is what's driving that. That feels very real looking at hundreds of US companies.
So many people we've spoken to today have talked about this idea of kind of filling in the gaps, meaning the private capital managers, filling in the gaps where the public markets either don't want to be or can't be right now. There has been, I don't know, virtually no IPOs of significance, and I don't know how long here. We have seen a pickup, though, in sponsor-backed M&A, and I'm curious as to where you see that trend going. Do you see that continuing?
I do see it continuing. Right now, as we sit here, it's hard to see a lot of kind of brightness on the horizon around public markets. There's just too much uncertainty. At the end of the day, private markets can look through this period of uncertainty to the other side. That's really hard for markets that are trading every instant and trying to make decisions every instant. So yes, I think that the private equity community and a couple $1 trillion of dry powder will play an important role in the ecosystem. Private credit's playing an increasingly important role in stabilizing the capital markets. I see that happening.